All right, so we are back for part two of the StreamlineiG investment strategies. Let's take a look here. So before we get started, as usual, this is our disclaimer. This is not financial advice. This is for the purpose of education. Our goal is to share the strategies that we've used at StreamlineiG that have worked for us. But this is not financial advice. This is for the purpose of training and education. So on our last video, we talked about what's called our mogul mode and finding ways to better use our time by owning your 24 hours. Most of us work for the purpose of producing income versus allowing our income to work for us. So mogul mode is about finding ways to use your 24 hours the best you can and producing more time by allowing your money to go work for you. And we've come up with 5 different modes of allowing your money to work for you. The first one is your foundation builders, which we talked in the first video. And those are typically your solid income generators that don't require a lot of your time. Today, we're going to talk about your conservatives and your growers and get an understanding about the difference between the two and how to manage those as far as watching and monitoring and identifying which ones you want to use and the difference between how you view and use those, as we call it, workers, your money to apply to these. So let's do a quick review of your foundation builders. Foundation builders, as I mentioned, are things that are more stable, that you know what kind of money you're going to have coming in. You know when you're going to get paid, you know how much you're going to get paid, and you know how much it costs. And for us, those are income stocks, your stocks that give you dividends. Typically, I like stocks that give a dividend of at least 7% or higher. I don't like stocks that hit over 15, 16% because I want to know, okay, if you're giving me all your money, what are you maintaining within the company to make sure that it stays in business and that it can grow? So those are things that I'm cautious of. Now, would I not get a stock that was giving had a 20% dividend yield? I might, but I'm going to have a strategy for it. I'm going to watch it a little closer, and it may be that I'm just going to hold it for 3 to 6 months or a short-term time frame just to make a lot of dividends or revenue from it, and then I'm going to let it go. Those are ones that I'll typically buy a ton of so that I can make quick money off of them and then let them go. But for the sake of foundation builders, I want things that I can buy. I can put employ, not buy, I like the word employ. I can employ some money from my account to go out and work for me. And there's a good surety that it's going to produce without me having to monitor it all day long. I gave a list of some pretty decent income stocks. I try to keep my stocks that I buy for income purposes below $20 a share because I can buy a lot more of them. Usually these aren't well-known name stocks. There are thousands of companies out there. Nobody knows every single one of them, but there's a lot of golden choices out there that pay out monthly, that the price of the stock is cheap, so you can get a lot of them. The other thing that we're doing is something called BlockFi, which is a cryptocurrency wallet. There's a lot of hype about cryptocurrency, and there's a lot of volatility with cryptocurrency. But the thing is, if you get a crypto wallet that pays you interest for simply holding your cryptocurrency there, then that helps you to produce income on a consistent basis. And it's something that, once again, as a foundation builder, you can pretty much put a guarantee on knowing how much you're going to get and when. And we like BlockFi because it gives 8.6% annual interest, but it pays out monthly, which means it compounds. Our favorite word, compound interest, but on our behalf, not what we're paying out to a bank. So those are the two that we talked about in the previous video. So let's take a look. We talked about how dividends work. You can go back and watch the first video of this series to kind of review that. So what are growers? Growers are stocks that we buy that are cheap. Well, they don't necessarily have to be cheap per se, but they're in a market that's trending, things that we're expecting to grow in the future. A lot of these are built off of hype because the business hasn't built itself up yet. A perfect example of this is Tesla. When Tesla, when I first started looking at Tesla as a stock, it was about $50 a share. And to be honest, I did not buy in because their balance sheet was horrible. They were losing millions of dollars a year. They weren't making any money for years. And I struggled with trying to get into buying Tesla because I didn't understand them. I didn't understand the business. I didn't see them selling as many cars as your non-electric vehicles at the time. So for me, it was a hard time. But later on, once they reached the $100, $200 range, okay, I started buying into the hype a little bit because I got an understanding beyond the car. It isn't just cars that they were selling. They were making batteries and they were in the new energy space. And that's what caught my eyes and my attention. Plus, there was a lot of hype. The more hype they got, the higher the stock price went. But still, the business wasn't making any money yet, not to where they're at the end of the year, their balance sheets were still red. At the end of the quarter, their balance sheets were still red, but they slowly began to not be as red as the previous quarter. So I started buying into Tesla at that point. It wasn't until a year, maybe 2 years ago, that Tesla actually had a green balance sheet, meaning they were actually turning for a profit. And now the stock it had went all the way up to maybe $800, $900 a share. It's still in the $700 range, but that's a long way from $40 to $50. So why share this story of Tesla? I'm sharing the story of Tesla because many of your growth stocks follow that same trend. They build off of hype. They build off of the stock price grows off of its potential and the hype of its potential of what the company can do. But with that potential, it is a rocky road. With growth stocks, I always talk about investing in the stock market being like riding a roller coaster. It's going to have its highs and its lows. Some companies, their highs and lows are slower. It spends more time slow grinding up, and it may dip a little bit and then it's going back up. Whereas growth stocks, you're on a whirlwind of a ride. It's like going to Six Flags and being on a free fall, and you just fall out the sky for no reason, going, what happened to the stock market? Your growth stocks, even Tesla still to this day, it went all the way up to $900. And within a month, it was all the way back down to $600. And now it's back up to $700. That's a lot of money. So when you buy into a growth stock, you have to have convictions as to why. Just as I stated with Tesla, at first, I wasn't on board. I still have a love-hate relationship with Tesla. But I had an entry strategy of my why, and I have an exit strategy of when I plan to leave Tesla. My exit strategy for Tesla is based on their ability to come up with more than just cars, because there's so many electric vehicle companies coming into that space and well-known companies, automobile companies that are heading into that space, such as Ford, GM, Porsche, Mercedes, Cadillac. They all have electric vehicles now. How is that going to affect Tesla? So I'm looking at what is the company doing to enter other spaces to bring income from more than just selling cars. So that's what I monitor with them. So with growth stocks, you have to really keep your eye on the ball as to what the company is doing, where they're going. If there's any business calls that I can attend, like the earnings call that they have quarterly for my growth stocks that I have high conviction in, I listen in on those. If I can't attend, I will listen to the recordings. That way I can know what is the company doing, what are their plans. That's important to know for your growth stocks, because you don't really always go based off of a balance sheet with growth stocks. You're going off of their potential by getting them early. So what are the things I look for with growth stocks? I'm looking at what is the trend as far as the economy. If you look right now, what are we talking about all the time? We're talking about EVs, electric vehicles. You have some states that have made it mandatory that within the next 3 to 5 years, all cars sold in that state must be electric vehicles, or a certain percentage, such as 50 to 60%. You have other countries that have mandated that the entire country sell nothing but electric vehicles within the next 5 years. That says a lot. You have countries that are putting billions of dollars into the electric vehicle space. United States has declared that they're going to put trillions, at least 1 trillion, into the space of electric vehicles. So when we look at things like that, that tells me that over the next 5 years, something's about to happen in the electric vehicle space. Well, what are those somethings that can happen? Of course, vehicles, we already see that, but what does it take to maintain and manage vehicles? Okay, well, right now you have to put gas in your car. What happens when most cars are now electric vehicles to the gas stations? They're going to have charging stations. Well, who makes the charging stations? What are the components that goes into a charging station? What happens with batteries? Because it will require different kind of batteries in your cars. What are the components that make up the batteries? These are all things you have to think about. When you buy an electric vehicle now, it also comes with the fact that you have to have a charging station at your home. Well, most cars that are electric vehicles, you have an option to include the installation of your charging station. Well, who installs them? These are things you have to think about. With growth stocks, you have to be willing to ask the question, what and why? How does this affect something, and who's going to do that? What are the companies that are doing that? And those are the things you're looking into to see if you can find an entry at a great price. But you really have to monitor those companies. So electric vehicles, we know. New energy, we have sun power, solar power. They're trying their best to replace oil, not just with vehicles, but with other types of things that require oil. Crypto. You hear about cryptocurrency every day. If I hear about Dogecoin one more time, I'm going to lose my head. Bitcoin. I'm big on Bitcoin because your major banks are buying into Bitcoin. Your high-end funds are coming up with new ways to invest in Bitcoin particular. They're not investing in other cryptocurrency. They're just creating it for Bitcoin. I want to know why. In the meantime, I am building up my Bitcoin. You guys have seen the videos on BlockFi, which we should be posting another one soon. There's a lot of cannabis news out there. We have states that are becoming more open to it and making it legal in their states. I believe that the entire United States will become legal soon, but we don't know when. And because of that, all of your cannabis stocks, your marijuana stocks, that's all hype. But you can get them now before it becomes legal, because once it becomes legal, the stock price is going to skyrocket. And the whole purpose of growth stocks is to buy them cheap, hold them with your convictions of knowing that in the future there's things coming that will will make this roller coaster ride go straight up. With cannabis stocks, you can buy some really good ones at like $20 a share. Hold them and wait. That $20 share, that $20 stock will drop to $15 on you out of the sky because the market fell out, and then it grows right back up to $20. That same $20 stock will go up to $30, $35 a share for no reason and come right on back down to $20. You have to have your convictions as to why you buy a growth stock and stick to it. Or as a part of your strategy, you could buy a growth stock at $20, let it go to $35, sell your shares and take your profit. That is also a choice. I've done that with plenty, even the ones that I have convictions on. Perfect example is Chargepoint. I bought Chargepoint at like $10 a share. Chargepoint went all the way up to like 30 something, I believe. I sold because I had tons of them. I took my profit. It dropped back down to the $20 range, and then I bought back in. That is also an option. You can play a game with your growth stocks. NEO, that's another one I bought in. I bought NEO at a little over $2 a share. NEO went all the way up to $63 a share. I took some profit, and then it dropped back down to the $30 range. Now it's back at $40. That's that roller coaster ride. NEO is an electric vehicle in China. You have no way of knowing exactly how far it's going to grow to. You just know that this is a space that is coming soon, and they're like the #1 in China for that particular market, that particular trend in electric vehicles. But there's so much uncertainty. I wanted some profits from it, so I took it. That's another example there as far as EVs. But crypto, same thing. Bitcoin, we see the banks are buying it up and making ways for it to be a part of their platform all over the place. You see major money makers, movers investing in Bitcoin. You see sports offering Bitcoin as a form of payment to players. That says a lot. So if it's good enough for billionaires to buy and millionaires to accept for payment, why aren't we? I'm in. But I'm using BlockFi because crypto is very volatile. When I say volatile, it means it can fly up and it can fly down just as fast. Take a look at Bitcoin. Bitcoin can go up $10,000 in one day and down $10,000 in one day. So I like ways and methods to buy crypto that allows you to earn interest for it holding there. And that is your leverage against the fluctuation in the price of the currency. Another trending market is Fintech, financial technology. That's your Squares, your PayPals, your Shopify. The way that we handle money is changing drastically. Drastically. How people shop and pay for services has changed drastically and is continuing to change. All of those companies that I mentioned are looking for ways, if not have already implemented, for you to pay for things with Bitcoin. So if you have Bitcoin, it can be a currency of exchange. That is huge. Going back to crypto, also check out not just the cryptocurrency itself, but how cryptocurrency is managed. What is the security of it? Take a look at blockchain. Blockchain is what's used to secure your cryptocurrency. Okay, well, what are the companies that manage that? You have your Riots, you have your Maras, you have your SOSs, your CANs. These are the ticker symbols for those companies, by the way. I am ticker friendly so much that I forget the names of companies. But take a look at those. But the key thing with our growers is that the risk is higher because these companies are not as established as others. Growers do not give dividends. Most. I do not consider a company a grower if it's giving dividends. The reason why is you need to be focused on growing this company, not paying out your earnings to your investors. Perfect example of this is Amazon. Amazon to this day does not give dividends. They never have. They've taken all of their income, the money that they've made, and they put it back into the company for it to grow. And now it's well over $3,000 a share. I'm still salty because I bought Amazon at $30 a share. I sold at about $400 or $500. I made money, but boy, $30 to $3,000 is a major change, but I digress. So your growth stocks are riskier. You have to have convictions as to why you're buying into your growth stocks, and you have to stay on top of them and watch them. I watch my growth stocks every day. I need to know what's going on with them every day. Now, if they go down, I'm not frantic and, oh, I got to sell, sell, sell. They drop down. My goal is to find out why. Why did it drop down? Did the entire market drop? Okay, if the entire market dropped, everybody on the roller coaster went down, not just my stocks. But did it drop because there's something major happening with the company? Is the company getting sued? Are they not functioning the way they said they were on the calls? I need to know the why. If I know the why, I can make a conscious decision. I say it all the time. A great investor is an informed investor. With your growth stocks, you have to stay informed and know the why. Don't wait for it to come on CNBC. Don't wait for it to show up on the news. You need to know before they know. And it's easy to do. Read Wall Street Journal. Go find a news channel, not so much a news channel, but you need to find a way to get information before CNBC does. The same way that I get information, I actually pay for it. There are tunnels, there's ways you can get information off Twitter. Twitter's free. Find the right people to follow and they'll tell you stuff. And I'm not saying just your average Joe, I'm saying people who do research for a living. You'll find information from them 2 weeks before it ever even shows up on CNBC. Most of those you have to pay for, but there's ways if you find the right people on Twitter. There's companies that you can pay for services for. I try to put a lot of that information when I find out about something right here in StreamlineiG, but information is great. Here are my top 5 growth markets right now. We're always looking for companies to invest in with these. You'll see the post about them as we find them, but that's what your growth stocks are. Keep in mind, like I said, these are a little bit more riskier. They're definitely riskier than your income stocks. Income stocks or your foundational income, that's solid. Your growth stocks, they're going to go up and down. You can take profit when profit comes, or you can hold them for the long term, but have conviction about it. Now, here's one that I like and I don't like, and that's called our conservative stocks. I have rules for conservative stocks to be called conservative. And the reason why they're called conservative stocks is they're consistent, but they're boring. They're consistently boring. They're boring because they don't move up too fast and they don't move down too fast. They will go in one direction or the other, but you're not going to make a killing as far as them being a growth stock. My first rule is that a conservative stock must pay a dividend. Conservative stocks usually pay a much lower dividend than your income stocks. If a conservative stock gives you 3%, you're good. A 3% dividend yield, then you're good. My conservative stocks must be either on SPY, on SPY, or on the Dow 30. The Dow 30 are the top 30 companies that the Dow deems as respectable, good, with good balance sheets. They've been in business for a very long time. These are typically stocks that Warren Buffett invests in. They are consistent. They've been around for a long time. Their balance sheets are good. They do good business. They're solid companies. They're not growth stocks. They will grow, but the amount of growth, the rate of growth is going to be slow. It's going to take a long time for them to for you to see a significant growth with them in most cases. Like I said, they're slow movers, but they're consistent. Examples, these are examples of companies that I do invest in, that I like, that fall into the conservative panel, I guess you would say, or conservative mode. Coca-Cola, anybody who knows me knows I love Coca-Cola as a company, as a stock. They're boring. Their stock price doesn't go up, but boy, are they consistent in paying their dividends, and they pay a pretty good dividend. They're normally around about $45 a share. You're not going to see much of a change in that. They are solid. That's a solid company that I can just buy, hold, and sit on for forever. I don't really have to watch it. I believe they'll have Coca-Cola in heaven as far as I'm concerned. It's not going anywhere. It's just consistent like that, but they're boring. McDonald's, another one. I started buying McDonald's when it was $60, $75 a share, but that was almost 15, 20 years ago. It's now at $200, but look how long of a span it took to get there. Not fast growers. Right now, they're in the middle of some revamping as far as real estate is concerned. They are designing buildings to be more pandemic ready. So they're putting a lot of their money into research and development. They're also looking into more plant-based. You'll see their menu changes with the times. That's what makes it a good company. The company doesn't sit there and wait for things to fall in on them. They started making adjustments and changes and pivoting based off of what is happening or what's occurring at the current time. Once again, this is a boring company for as far as growth, but they give a good dividend. Their price is high though. You're looking at over $200 a share. Most conservative stocks are a lot higher in price than your growth stocks. J&J, Johnson & Johnson, another one that pays a nice dividend, but they're boring. They're consistent. They get lawsuits out the wazoo, but their stocks still grow. Well, I won't say grow, but they still stay consistent. They don't lose a lot of money. And I believe it's because of the space that they operate in as far as healthcare is concerned. You have your Microsoft. I love Microsoft because Microsoft is a borderline conservative, borderline growth stock. They don't give a lot of a dividend. They give a little bit, about 1% dividend yield, but I like them because of their potential for growth as well. They're one of the fastest growers off my list, but they are a conservative stock. They're consistent. Their balance sheets are always great. They have plenty of cash flow to work with. They're always working on something new. Right now, they're really aggressive about buying other companies and moving into different spaces. So I really like this one as a conservative stock because of its potential for a lot more growth. Apple is another one I really, really love. Apple has been sitting in the same space as far as their price range. They're about $130, $140 is where they tend to tinker around at, but there's so much potential for growth. They give a small dividend, once again around 1.6%, very small, but there's a potential for growth with them. But once again, their balance sheets, amazing. They have money to work with. So they are not a growth stock. They're really good conservative stock. So these are my top 5 as far as conservatives that I keep in my portfolio. Now, we talked about growth stocks and we've talked about conservatives. We've also talked about your foundational. Those are 3 different modes. Do you have to buy all 3? No. You find what you're more comfortable with. If you're not comfortable with the risk and the fluctuation of growth stocks, you don't want to open up your brokerage account and look at all that red and next day it's all green and you can't handle the fluctuation, don't buy income stocks, growth stocks, I'm sorry. Stick to income. If you want a little bit of both, get your conservatives. They're boring. I'm gonna say it again. Conservative stocks are boring, but at least you don't have to worry about having a heart attack because you keep coming in seeing red and then seeing green and then seeing red. Conservatives are consistent. Now, even when the market changes, where if the entire market plummets, which we have our days, which that happens for various reasons, conservative stocks, they're pretty good about bouncing back. That's the thing with conservatives. Even if the market goes down, yes, they can go down too, but they bounce back. And you're getting dividends. We love dividends. So that's it for our growth and conservative strategies. Once again, find the strategy that works best for you. And you can do more than one. Everything I'm telling you is what I do. I do a multitude, do all the strategies we're talking about here. So that's it for part 2 of your StreamlineiG strategies, or AKA mogul modes. We're on in our 24. Have a great day.